Is Rolls-Royce a buy or a sell? Let's get started with the model. This is a large cap company, 49 billion pound market cap. They're trading at 580 pence or 5.8 pounds, and they have 85 million shares outstanding. Rolls-Royce is one of the world's largest manufacturers of aircraft engines. It was founded in 1884, headquartered in London, UK. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. 2021 was rough, negative 4 billion pounds. It did get better in 2022, negative 800 million. Positive 1.8 billion in 2023, up 42% in the trailing 12 months to 2.5 billion. Margins 14%. That means they convert 14% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. A big negative in 2021, a small positive in 2022. Then it looks pretty good in 2023, 2.4 billion. It came down a little in the trailing 12 months to 2.3 billion. Margins 13 to 15%. Revenue is a sales for the company, and that came down in 2021 and 2022 due to COVID. It came back up in 2023 to 16 billion, then close to 18 billion in the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 71 billion. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $61 billion. We divide that by 85 million shares. And we get a calculated stock price of 720 pence. They're trading at 580 pence, so they're trading at a 20% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 71 companies in the same industry as Rolls-Royce, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 700 million in capex. We can't look at their debt to equity ratio since they have negative equity. They don't pay a dividend. They generate a lot of free cash flow, 2.5 billion. They rank 8th in market cap, a bit ahead of Axon, pretty far behind Northrop Grumman. We can't look at their price to book since they have negative equity. Price to book is stock price over book value per share. Since their book value is negative, it would give us a negative result, which doesn't make sense. They're trading at 21 times earnings, 20 times free cash flow, and 2.8 times revenue. They generate 18 billion of revenue. If you put $10,000 into this company 10 years ago and reinvested the dividends, at one point you would have been at $1,000, down 90%. Because I think it got down to like 40 pence, maybe even lower. But I remember in 2020, it was real low. I was thinking of buying it, but I don't like buying stock on the OTC, and Royce trades OTC. It's come up a lot since the bottom, but you'd still be down 40% if you put money in 10 years ago. To summarize, I have them trading at a 20% discount, ranking 6 out of 10. I do like this company. They've been around well over 100 years, and they're one of the largest aircraft engine manufacturers, which is something there's always demand for. So short term, 6 out of 10. Long term, 7 out of 10. Pretty good ratios. Their PE and price to free cash are a lot better than median, 7 out of 10. Financials look great because their revenue is up 55% since 2021, and their free cash flow went from negative 4 billion to positive 2.5 billion. Let's take a look at their latest presentation slides so we can learn more about the company. Rolls-Royce proposition: high-performing, competitive, and resilient business. Growing sustainable cash flows. That's important. Strong balance sheet and growing shareholder returns. Well, they did eliminate the dividend. They used to pay a dividend, they don't anymore. So when they say shareholder returns, I guess they're referring to stock buybacks. Because there's 2 ways to reward shareholders: dividends and buybacks. Here's their segment: civil aerospace. Leading positions in business aviation and exclusivity on the latest Airbus wide-body aircraft. The 2 plane manufacturers are Airbus and Boeing. That's almost the entire plane manufacturing market. This company makes the engine for the plane. Boeing and Airbus make the whole plane. Defense with a C. Long-term pipeline and leading position in transport, combat, and submarines. They do manufacture submarines. Power systems, structural advantages. Nuclear, broadest capability portfolio in the industry, fueling growth in defense and commercial applications. It's funny seeing the words in British. Fueling with 2 L's. Their group segment, global brand, deep customer relationships, and experienced partner. Here's their midterm targets. This is based off of that 2027 timeframe. Operating profit 2.5 billion to 2.8 billion pounds. Margins 13 to 15%. It was 10% in 2023. Free cash flow 2.8 to 3.1 billion. And return on capital 16 to 18%. I'll give you more color on ROE, return on equity, and ROC, return on capital. ROE measures a company's profitability in relation to its equity. Equity is assets minus liabilities. ROC measures the same thing, but also includes debt financing. So in addition to equity, it includes debt financing. So you'd want to see a higher ROE and ROC when investing in a company. When you buy stock, you're an equity holder. That's why a lot of people focus on ROE. The calculation for ROE is net income over equity, shareholders' equity. Equity is on the balance sheet, like I mentioned earlier, assets minus liabilities. ROC is net income over debt plus equity. Here's their operating margin by division, civil aerospace. The forecast is 15 to 17%, real low in 2022, 2.5%. Defense, 14 to 16%. It wasn't nearly as low. It was 12% in 2022, 14% in 2023. Power systems, 12 to 14%. Here's the market growth rates. For commercial aviation, 3 to 5%. This is the growth through 2030. Defense, 0 to 2%. Power systems, 5 to 7%. The growth for wide body is larger than business aviation, 5 to 7%. Wide body is a larger aircraft. And the growth for mobile applications, 4 to 6%. They are doing a good job at being more efficient. They cut 2,000 to 2,500 jobs. The focus is on efficiency, simplification, and enterprise-wide synergies to create a more agile business. Also, 200 million pounds of annual benefits. So they're reducing their expenses, total cash costs over gross margin. They're reducing it 40 to 50% from 0.8x to 0.5x. They're trying to transition to lower carbon to help the environment. Lots of companies are trying to get to net zero emissions. Lots of countries said net zero by 2050. So this company is on a path to do that. Their main business is civil aerospace. That's the blue on the bottom. And you can see that gets larger over time. That's the manufacturing of aircraft engines. Their second biggest segment is defense. Then power systems, SMR, and new business. SMR is small modular reactors. They're developing power plants to generate electricity using SMRs. Their revenue for the first half of 2023 was 7 billion pounds. The first half of 2024, 8.2 billion. That's up 19%. Gross profit went up 33% from 1.5 billion to 2 billion. So margins grew quite a bit from under 22% to over 24%. Operating profit went from 670 million to 1.1 billion, up 74%. Operating margin grew a ton, under 10% to 14%. Profit after tax up 87%. Their free cash flow more than tripled from 350 million to 1.15 billion. And remember, return on capital, net income over equity plus debt, that's 14%. It was 9%. Net debt is debt minus cash. That went from 2 billion to 800 million. So massive improvements in every category. Here's a breakdown of their sales. 68% large engines. That's up 18%. Business aviation is 25%. That's up 66%. Regional is down. It's only 3%. That's down 2% from last year. And V2500 is up 33%. The Airbus A320 plane uses the V2500 engine. Their total deliveries went up 26% to 236. Large engine deliveries, 120. 7.6 million flying hours. That's up 22%. LTSA is their long-term service agreement. So the more miles their engines travel, the more money they make on servicing those products. So there's 624 shop visits. That's up 6%. This chart is just civil aerospace. This chart is defense. Their biggest part of defense is submarines at 34%. That's up 84% from last year. And they have a backlog of 8.5 billion pounds. So they have plenty of business coming. Here's their power system segment. 43% of their revenue is power generation, 1/4 is government, and this segment has a backlog of 4.6 billion pounds. Their net debt has improved a lot. It was as high as 5.2 billion pounds in 2021. It looked like in 2020 or 2021 they could go bankrupt. They were burning a lot of cash flow, no pun intended. Things are back in place. Their net debt is below 1 billion, which is better than 2019. Here's their full year 2024 guidance. Operating profit 2.5 to 2.8 billion. Margins 13 to 15%. Free cash flow 2.8 to 3.1 billion. Return on capital 16 to 18%. For 2023, 37% of their revenue was in Europe, 31% in North America, Asia, Middle East 26%, and the rest of the world 6%. And the bulk of their revenue is civil aerospace, 7.3 billion pounds, then defense and power systems. Let's take a look at the company on Simply Wall Street. Its last price, 5.8 pounds, 49 billion market cap, down 1% in the past week. Look at that, up 90% in the past year. Here's the stock price since 1992. It looks like it was 1.4 pounds. Then over the next 11 years, it came up to almost 3 pounds, then back down to 71 pence. That was in 2003. Its all-time high was in 2014, almost 13 pounds. Hopefully you didn't buy it then. Then over the next 2 years, it came down 50% to around 5.5 pounds. That was in 2016, up to 10 pounds in 2018. And then it reached its all-time low, 69 pence in October 2022. I guess hindsight's 2020, because I remember when it was under 1 pound, thinking it was a good value. But it's always hard to buy a stock that's coming down so much, because you think it's going to keep going down. We do the opposite. When a stock is going down, we avoid it. When a stock is going up, we buy it. But it grew about 9x from that bottom, getting to about 6 pounds just last month. Not quite at 6 pounds, 5.95 pounds. Pretty close though. It's down a little since then, not too much. Simply Wall Street's bullish on this one. They're at 11 pounds. They say the stock is 47% undervalued. 18 analysts priced this stock pretty much where they're trading at. Their revenue pre-COVID was between 14 billion and 17 billion pounds. Then when COVID came, it fell to 11 billion pounds. And it took a few years to break through its pre-COVID levels. It finally hit 16 billion pounds in September 2023. Now it's close to 18 billion pounds. They do have a lot of debt, 2.2 billion pounds in 2014, up to 6.5 billion in 2020. They reduced it a little bit. Now it's down to 3.7 billion. Their equity was positive in 2014, 15, 16, 17, also part of 2018. Then at the second half of 2018, it became negative, and it's been negative since then. When a company has negative equity, that means its liabilities are higher than its assets. They actually have more cash than debt. So even though they have negative equity and a lot of debt, they're not in bad shape. Because when you have more cash than debt, it's as if you're debt-free. The CEO's compensation is 14 million pounds, tenure as CEO, 2 years. Here's a good sign, lots of insider buying, no selling, only buys. 78% of the company is owned by institutions and 20% by the general public. The biggest shareholder is Capital Research, 7.7%. Then BlackRock. The employee stock plan owns 1.8% of the company. UBS, 1.5%. HBOS, 1.1%. And Morgan Stanley at the end at 0.77%. Their employee count has gone down a lot from 54,000 to 41,000. And the ticker trades on the OTC Pink Sheets, Deutsche Börse, London Stock Exchange, Zicha, BATS Europe, and Mexican Bolsa. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.